All right, everyone. I think we're live here, just getting the stream going and starting, trying to do a perfect time for you. So I got about 45 seconds, give people a chance to join in if they're interested. We're gonna plan out kind of a triple calendar, double calendar spread today. That's what we'll take a look at ultimately, just because with the market conditions as they are, the way that we're moving and working things, it's definitely down quite a bit, especially over the last couple of days. If we look at the S&P 500, we've had a couple of down days, but we were at all-time highs. So if you look here at where the market was, it continued to grind up incredibly high, with no pausing, no breaking in between. A little bit subtle breath, but you really just had this one little bit of a downward movement, but beyond that this market's been flying higher quite a bit. So with that, always a concern and a little bit of worry. So today my goal is to give you some thoughts and insights on building a double or triple calendar, when I might do these kinds of trades. And really this is to kick off our options membership that I'm testing out. So we'll see how things go. If you're interested in the membership, go ahead and you can go to our website at TRADERSFLY.com. Once you're there, you can go to the members section here. And from this members section, there's a couple of ideas I have in mind, but it's going to be this options membership. So when you go there, it's under pricing and plans, option ideas and strategies, and you can go there. And this one right now we're doing for free here on YouTube. So just to give you an idea what it's all about, we did one a couple months ago on Tesla, so you could review that as well. And my goal in this options membership is to, number one, answer your questions. So if you have questions, think of it as an alternative to a coaching session. So if you don't want to pay for a full hour in-depth one-on-one coaching session, which you can do if you like, but if you don't want to do that and you just have some periodic questions, you can do this kind of more on this options membership plan. My goal is to have 1 or 2 times live per month, and then the others I might just kind of get in there and start doing it, just because then I don't have to schedule exactly at 10 o'clock or 2 o'clock in the afternoon. I can just do them, hey, right after lunch, let me just take care of it. So it's to open up your mind, to get you thinking a little bit more about the trades. It's not necessarily, hey, do the same exact trade, because everybody's risk tolerance is different. So bear that in mind, that I'm not telling you to trade these things exactly. There's no alerts when it comes to options. If you've seen those kinds of memberships, those kinds of things don't work, because with options, you're going to be doing the same trades over and over again. Yes, volatility might be a little higher one time than another. But as far as getting an alert on options, unless you're doing directional single options, that's not what this is about. This is about teaching you the right way to think about your money and your portfolio. So if you're interested, go ahead, sign up. It'll help me out, help the employees out, the team out that we have that post the regular free videos, because 99% of our content is free. And it'll help you out to learn more about option trading, whether you stick around for a couple months or maybe for life. So we'll see how things play out. So in today's option trade, my goal is to do this double or triple calendar. We'll take a look at the market real quick. If you have an idea of which one you'd want to do a double or triple calendar on, let me know and post it in the YouTube comments there, and we can go ahead and take a look at it. Now, let's just go over a couple things real quick. When I do the options trade, when we're going to look at them, we're going to do them on a sheet. And I think doing them in a breakdown way is a lot better. So we're going to look at it kind of like this, always breaking it down, so that way we have a good idea of, hey, why are we putting this trade on? So we're going to look at it, hey, what's the market doing? What's the stock doing? What's the VIX doing? Where does this trade fit in? Because a lot of times when you see these kinds of things, on maybe other videos, other channels, they don't really look at it, where does it fit into your money or portfolios? And in long portfolio income trading, speculative trading, where does it really fit in, and how does it all work? And then I'm also going to look at how you kind of profit from this. What do you want the delta, theta, vega to do? Because I find a lot of people are always confused on the Greeks, so we'll kind of make sure you understand that. And when to take profits, I call it juicing it, because you get a little bit of juice from one orange, then another. So you're trying to always take a little profits, and where's the pain points? So we'll talk a little bit about that. So let's kind of get into it. If you have any other questions in between, feel free to let me know as I hop around through the panel. What we're going to do is I'm going to look at just to show you where we're going. I already have a triple calendar trade I put on a while ago. So I do these kinds of trades for coaching students. Sometimes I put them on for learning experiences for other people when I work with people one-on-one. So I'll put these trades on, and you could see how they kind of work and perform. So we're going to do one with the Caterpillar right here. You can see right now with this down day, we're down about $43. And overall on this portfolio, I mean, with today being kind of a significant down day, we're down about, 33 points on the S&P. I've got a 358 delta positive, theta 431, and a Vega, still a negative Vega, but most of these, I will say, they're positive Vega. It appears like it's negative, but that's just because some of these trades that I have set up are a little bit smaller movement in price. Like, for example, Apple, it doesn't move as much, even though it's got 122 negative Vega. It's not as big of a mover as maybe like S&P or the Russell, which you can see I've got a lot of Vega stacked there. So anyway, so we're only down about $100, $200 for this all these trades. So it's not too bad. But the trade we're going to work on today is kind of like this Caterpillar trade. So I put this on a while back, and what you can see on this trade example here. And let me go ahead and here we go. Set this up. So this is what it looks like. It looks a little funky. This is typically what the trades that you do in a real account would look like. They won't always be perfect. It's not going to be a perfect calendar. It's not going to be a perfect setup, and then you just kind of set it and forget it. You probably will do some tweaks to it. And when you look at this trade breakdown, it's got one contract here at the 135s. I got 3 contracts at the 140s, and I got 2 contracts at the 145s. Now, this trade right now is up about $282 overall, down about 34 for the day. And you can see we're at this 136 level. Now, I put this on a little bit earlier, obviously. So when I did this one, we were down here kind of at this downward level. We went down, then we came back. So we're almost at the same point. And this is how this trade has been working. It's actually been working just fine. I put it on as more of a longer term play and investment. Now, when you go into these double and triple calendars, I find oftentimes you're looking at creating a synthetic position. What does that mean? That means that if you're trading a stock like a CMG, an Amazon, maybe even an Apple, or anything big like a Shopify, you don't really need, here I'll just show you an example, you don't really need a double or triple calendar right away to start. In fact, I would rather prefer a single calendar because you have enough width in the position. So just to give you an example here with Shopify, let's say we go in and do a calendar spread here, and here's our example. Well, let's take a look. Well, here, look how wide this position is. Let me change it to a fixed, get rid of these other price slices. So now this can move around quite a lot. Well, I could go in, well, say, hey, I want it a little more bullish. I could change it to a 535. I want it even more bullish. I could just shift it a little bit to the right, and the changes that happen are small. They're incremental, so I can really tweak the amount of risk I want to have to the upside just by moving it a little bit. So I can move it a little left, or let's back it up a little bit and let's move it the other way. And you can see I can just shift around that position quite a bit. And of course you could do puts if you want, no big deal. Tomato, tomato. So I could go ahead and shift it this way or the other way. Now, the issue becomes when you start trading lower dollar stocks. When you start trading lower dollar stocks on these kinds of things, this is when this becomes a little bit of a problem, because I'll show you that trading anything like, let's pull up here, Bank of America, like a $34 stock, and we'll go to about the same time frame. You can see that this doesn't have a lot of premium, and because it doesn't have a lot of premium, there's not enough juice that you can extract from it. So In that case as well, there's not a lot of strikes. So if I go and let's just buy a calendar as an example for you, and I'll bump up a couple of contracts just because it's smaller stock. Let's say 10 contracts here. So if you look at this one, if I go kind of right near the money there, or at the money, I'm at 35, and you can see my position, the current price is a little on the left side, or ultimately it is, the calendar is to the right of the price. Now if I go to 34, look at how much it shifts. It shifts a much larger degree, and it's a lot bigger of a move anytime I make that change. If I go to 33 now, all of a sudden, boom, I'm almost out of the calendar. So this is when I like doing these kinds of double and triple calendar approaches, because what I could do is do a real nice setup to create something that's synthetically a calendar trade, but mixing in double and triple calendars. So it's because I have this problem of a big shift, okay? So if we look at setting one up, I don't know if anybody has a suggestion of what they want to do. I think I might as well just do it on Bank of America since we're here. If you are bullish on this position, let's say Bank of America, you're kind of saying, hey, well, it might go up, but I still want to counter a little bit for this downward possible trend, because let's look at our breakdown. How would I break down this trade? First off, let's check at the market. Well, the market, what has it been doing? Here, we're kind of near the lows. We've been moving higher. We've had a little bit of a pullback, and then we continue to pump higher. We've got a couple of down days here, but ultimately, I'd say we're at all-time highs. So if we check out our sheet here, this is what I want to do. Okay, let's look at it. The market is at all-time highs. Okay, what about the stock? And then what about the VIX? Okay, where are we with that? So let's go back and let's check this out. If we look at the stock now, if we're doing Bank of America, okay, here, where's the stock? Well, it's kind of near all-time highs as well. Okay, somebody just suggested Facebook, so we could check out Facebook here in just a second. So you can see this one's kind of at all-time highs. Facebook, if that's the one you want to do, great. Let's check it out, because it's probably going to be very similar, because I know it's near all-time highs. Same thing, right? Because we know the market's at all-time highs. Facebook's near all-time highs. So, okay, well, do I think it's going to break out? I don't know. That's the thing with option trades, is you don't have to focus and worry about the breakouts. You have to focus on managing the trade. But you have to look at where's this going to fit in. So the stock's still been climbing higher. That's on a weekly basis. Let's look on the daily basis here. We're still near all-time highs, but I do want to budget for a possible pullback, right? So I'm trying to set up a couple of calendars to kind of counter this. Now, doing a double or triple calendar on Facebook, you probably don't need it. Let me just double check, only because it's got enough premium in it to probably make it work with a single. But even then, the shifting of it, it still shifts quite a bit. So yeah, maybe you could do a double or triple. So let's go with Facebook. That's what you guys want to do. All right, so then here, okay, stock also all times or near it, right? I'm not saying it's at all-time highs, but I'm saying it's near there. The VIX is the next thing you want to check, because this is what you have to look into account, the premium with the volatility. So when we look at the VIX, I like doing it on this program here. The VIX, as you check out the recent movements, okay, so here's kind of been our range. Okay, you could almost look at it kind of like this. So these are our highs. This is kind of our lows. So really, we are near the highs or in the middle between our recent range. So what does that mean? When I do this, if I'm setting up a calendar trade, that means if we get a VIX to come down, if the VIX comes down, I'll be hurt on the volatility side of my calendars, which means I need a little more delta, which means I need a little more cushion for the upside. Even though it may look much more bullish, I need a little bit more delta to cushion that effect. Okay, so let's go ahead and check this out. Right. So now, going back, VIX is I'd say kind of mid to upper, it's a range. So we have to take into account. So now, where does this trade come in? Are we doing a speculative trade, income trade, portfolio trade? Portfolio trade means I'd want more delta, means stocks go up. That means you're looking for a long-term investment. Income trade means you're a little more neutral on price. You want to make more money on the theta. Speculative trade, it's directional, either down or up or theta. You know, it could be shorter duration. So I'm going to do this on a safer note just because we typically have more beginner traders in the YouTube space. For those of you in the membership, you know, we'll be a little more active and specific to what your needs are. But let's say we're looking kind of in the long portfolio, but we still want to capitalize a little bit on the income trade because, hey, we believe in Facebook. Let's say we believe Mark Zuckerberg's going to be great. So our risk profile picture is going to look a little funky because we're going to put on a couple of different setups, right? We're going to do a couple calendars here. We'll probably do a couple more on this side and one more here. So the price will probably be somewhere here. So it's going to look a little weird, but this will help cushion us for the downside. We don't want too many here. This will help us get us some theta, and this will give us the long portfolio extra delta we need and to compensate for the VIX, right? So I'm compensating for that VIX with some of these. I want some theta, and I'll get some theta also from all of these as well, but it'll be minor, but this one will be a theta worker, and this will be a little protector. Okay, so it just depends how much protection you want, how much long delta you want, how much theta do you want. So you're trying to balance these things out. And we'll go to the panel here in a second. So now I'm looking at, okay, what do we want price to do? Okay, price in general, we're going to want it to stay or we'll want it to go up. Okay, because it'll be a long portfolio, but we'll still want to get some theta. Theta is going to be positive, and the Vega, we actually will want volatility to go up because all of these will be positive Vega trades. Now, we are in the mid to upper range on the Vega. So that means chances are it's actually going to go down. So that's why we need to compensate some with the long delta. When do we want to take profits and juice it? I'd say once you're about, you're aiming for maybe 10%. If you're new, you could aim for 5% of the capital you used. So this would be your margin. Okay, get out points and risk. Well, if you're looking for 10%, let's say your trade is $3,000. So that means your goal is looking for about $300. Your get out zone would probably be about 600. It could be anywhere between 600 or really about $500, a little bit less there than double. And why is that? Because we want probabilities to work in our favor, right? It's got to give it some room to wiggle. All right. So we got a question here. Hey, just have a question. Just started searching about trading. Can you tell me how should beginners start with 50 to 100 bucks, and how should you choose a winning stock? Basic knowledge, please. Winning stocks just depends how long you're gonna hold things for. How So we got a question. It depends. There's no such thing as a winning stock in a way because they're all winners. Just depends how you trade them. You basically are looking for how do we set up the trade? How do you manage the trade? So starting with $50 to $100, I would say invest in your education, some books, that kind of thing. All right, so let's get this trade going and we'll do a setup. So if we look at Facebook, just to double check, doesn't matter too much since the last 5 minutes, but it's moving a little downward. And but we are at all-time highs. So how do I set up this trade? We got one calendar. Let me just duplicate a couple of these. So I've got 3 different calendar setups. And now I want to go ahead and start stacking some things. So let's bump this to about 3 contracts. This will be our theta, kind of theta play right here, this one. So we're making money on this theta. The next one I want is more a little bit on the bullish side. So let's go to 215. And this one, again, let's bump up some contracts. We'll do 2 contracts. So you can see this one will be a little bullish. So this will be kind of our hedge for our delta. And I probably want about 3 of those because if I did 1, well, remember, with the volatility, you'll get hurt if the volatility comes crashing down. So you do want a little extra cushion on the delta. And by having the calendar a little to the right or more bullish, that gives you that extra delta right here that you find. Okay, now combining these two, you could see what I've done is now I've got almost a double calendar. Now, could I go a little further out? Yeah, if it's a little too tight, you could spread it out a little bit further. And now you're playing with these ranges. I don't think 217 is traded, so 215. So you're playing with these ranges. You could almost do a quadruple calendar on something like this. But let's keep it here at 215. And let's go to the next one at 210 right here. And we need a calendar for protection. So we'll go 205. Now I probably only want a little protection because remember, with the extra Vega, I get cushioned when this stock pulls back or when the VIX pops. So I don't need too much protection in the sense of I'm getting a little kickback from that volatility. I still, of course, am worried about the price, but I don't need to overcompensate for the protection because the volatility is going to help me out. So here, if I now combine all these, okay, and I got one contract here, one contract there. So you could see this now creates a little bit of a hybrid position for my spread. And this is now my triple calendar setup. And you could almost look at this as this is a single calendar for me. Okay, so if you're trading a little larger, if you in your mind now think of this, all these pieces as a single calendar, now you've got a little bit more of a hybrid position that's a little wider rather than just doing kind of this calendar at the 210. Because what it does is if I add these strikes in, and let's just drag this over, here's our break even here, and here's our break even over here. By adding this other one in, it shifts my break even to the upside because we do want it a little bullish. And then going the other way, I go ahead and widen it a little this way. So it's not a full range, but I shift it because I need that extra delta. So now you got to decide, well, how much extra delta do I need? Well, here's your Vega. Your Vega is 57. So you got quite a bit of Vega, and what you need is, well, 51 because I have these other, that's this one. What I need is probably more delta than just 7. Because I have 7 delta, and that's not enough maybe to cushion for the ratio of Vega. Because it's, if you look at it, you know, you got about 7 times 7, you get 49. So it's about 7 times the difference. So I might want to bump up some contracts here. So what I could do is bump up the contracts, or you could reduce the contracts, and I could go more like the 220. And now you're structuring your positions kind of based on the shares. So you're playing with the contracts to create a position that's, hey, I still want it bullish, but I don't want to be too bullish. I want to still compensate a little for the downside. So do you want to be a little more extended to the right here for the bullish side, or would you rather be a little more protected? For now, I would say I would personally rather be a little more protected. And why is that? Market's at all-time highs. This is still at all-time highs. So I'd still be a little more cautious. If Facebook, let's say, broke 224, 225, because do I need to be in a rush? Then I would start to be a lot more bullish on it. But you'll see it. You'll see this trade to start move kind of to this 216, 217 range, and that's where you would kind of do the adjustment to 216, 217. So it'd be right around that 220 area. So setting up something like this, it gives you a nice hybrid, versatile position. Now, how much cash or where do you make the tweaks or adjustments on something like this? Well, here's what you do. You look at your cash used. So let's say on this trade, I'm using about $2,600, call it $2,650. So going back to my example, if we're using $2,650, well, probably looking to make, let's say, $250, a little less than 10%, and I don't want to lose probably more than 400. Okay, so I've tightened that up, but 250, you know, about 8 or so percent. So 250 and a lose of 400. So let's take a look at our screen here where this would be. So in a few days, as this continues to kind of rock out, you let it coast, and you'll probably get some price wiggle. Now, as this goes down, I don't want to lose probably more than 400 is what I said. So your price range, what you're looking at, is somewhere about 198. Okay, because that's where I would probably lose out. Okay, 198. We're not talking about adjustments yet. We're just talking about a no touch. Here's kind of a triple calendar. Here's an idea. Here's a no touch. So I'd probably take my losses right under the 200, about 198. And then on the upside, well, let's just say it does explode. Well, I would probably do an adjustment. The way I would do this is I take this off and maybe reset it over here now for more bullishness, because I would start seeing it move and the market would restabilize. But if you were doing a no touch, well, again, maybe about $400, this gives you about a 226 level. Now, if you're believe in the stock, hey, no problem. What would I do? If you were really bullish on this long-term, more investment type, I would say increase the contracts on the 220s. And what you can do is reduce some of the contracts on your current at the money price. And this gives you a little bit more of a setup closer to something like this. So now I've got a kind of a 2-4-1 spread. And that's if you're a little more bullish. This would say, hey, if you're expecting a market pop, if you're expecting the stock to come back to all-time highs, I'd do something a little more like this. And again, the range as far as managing the trade would be no different of where you take the losses. So it's the same concept. Take a look at your capital, look at it like that, and budget it accordingly. So this would kind of be the setup. And as this price continues to wiggle, you know, do your thing, do your management. Take some contracts off, because you'll see some contracts will be worth more than others. And I'll just show you here on this Caterpillar trade. You'll see that right here, as I take all these off real quick, take a look at this single contract. Well, this contract is worth $78. So could I take that one off and move it to another area? Yeah, absolutely. These three are worth 185. Well, could I take all three off? Yeah. Could I take just one off? Yeah, I could take just one off and move that cash and capital to another area. And then also we've got these two contracts, which are more bullish. Well, if the stock is now hanging out on this edge level, even though it's a $40 contract, well, I'd make $40, call it 30 maybe by the time the bid-ask spread gets in. Could I go ahead and do that? Yeah, you could just take it off, wait, and see what happens. And if it starts moving back up, then go ahead and re-add these. So anyways, that's kind of the long and the short of a basic trade like this. We've got a question here. Hey, good morning, Juan. But when you set up the calendar as a first leg is a selling leg, you are not expecting that leg to have a high volatility and the second one to have lower volatility as you're buying the second leg. So if the volatility crash, you might benefit in the short term. Yeah, when I'm looking at setting this up, if we're talking about Facebook, you know, I'm putting it all in as one, because if I'm setting this up as one, I'm thinking of this as an individual single trade, right? A lot of people get too confused wrapping their head around, hey, well, I got 2 here, 4 there, 1 here. When I'm doing that initial setup, I'm looking at it as a single trade, and it's positive vega. It's still overall naturally positive vega. And because of that, I'm looking for that volatility to pick up. Now, if you're a little more bullish, a little less bullish, you know, you're shifting these contracts around. That's how you manipulate these based on the risk you want to take on, because there's always a give and take relationship. Yeah, you're going to benefit. The closer you are at the money, you'll get a little more theta. You know, that's a little bit of a trade-off. As you bring these things further out like this, you'll get a little bit more vega. So you're tweaking some of these things based on the relationship of what you're trying to do. And I would just put them all in like right away, boom, 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 and there's your spread. Because I'm thinking of this as my hybrid situation. If I was to do it on Bank of America, just to show you real quick, this is how quick I would do it. I'll put on the trade. I already looked at this one just earlier at the beginning, so let's just go into it. Let's just set up the trade. Could be a good learning experience. If we're looking for Bank of America, and you know, I think it could actually come down. So let's put on a lot more contracts here, just because it's a smaller stock. So you're not even using, you know, here's 500 in capital, so it's not a ton. So I might, that's what it's nice to play with these contracts, because your adjustment is not too bad as you tweak these prices. And let's do another analyze the trade, and then we go kind of to the 33, and I'll do less contracts here, just a little protection here, but I still want to be a little more bullish, so that'll be my 35s. Put these a little down, bring these a little up, and now you're looking, okay, well, I got about a 10 delta. Is that enough or not? Well, you know, you kind of start the trade and then see how things play out. So, because this one will probably wiggle around, because theta is only 4 and you're really putting on only about a $800 trade or so. So I just hop on in there, get in these trades, and of course you could do some puts, some calls, because some of these will probably be a little more difficult to fill, just depending on where they're at positioned. And bump this up. So you could see I did all calls, but again, not too stressed about it because it's at the money, real close. If you wanted to be a little more safer, you could do out of the money. All right, are you buying in this case, we are set multiple calendars. Is not better to set up an iron condor? Well, one, when you're looking at a calendar is completely different than an iron condor. Calendar is positive vega. Iron condor is negative vega. So they're two different types of trades. They work kind of opposite of each other. So it's not that one's better than the other. It's that they function differently. That in a look at it like this, just to answer your question. Here's a Tesla example. I don't think I have Tesla here, so it won't get confused. I could set up an iron condor. Here is sell an iron condor. Okay, and if we go here and we just go into the puts, what's the current price of Tesla? 800 or so. So we'll go down to about 600 on the puts. Okay, here we go. All right, so here we have this, and we'll go up to about 1,000 on the calls. Okay, so check this out. Iron condor for you, right? And we bump up the contracts, let's say, right here. You're at a negative vega, right? So when you look at an iron condor, that's a negative vega position. And you know, the more you stack, the more negative vega you've got. Now, if I look at a calendar, just to show you, buy a calendar, check this out. And again, let's stack quite a handful of contracts. That's a positive vega, positive vega, positive vega, negative vega. So if I look at volatility, let's say volatility bumps up 5. Well, all of a sudden, if the VIX pops 5, I'm up $800 on this one. What's going to happen to my other one, my iron condor? Well, check this out. I'm down $400. Why? 5 times 90, 9 times 5. Well, it's roughly about that. So that's the difference. Now, if I look at a negative, well, let's reset it back to 0. Don't want to confuse you. We're back to 0. Now, if I go -5 on the volatility, this one makes me $480. But the calendar, all of a sudden, I'm down $800 because it shrunk. That white line drops. So 2 different trades, 2 completely different situations. But not to blow your mind here, guys, but we talked about this in one of the classes. If we do a custom setting and I just go ahead and take this from April to May and do this one from April to May, I've got more of a double diagonal spread, and it may look funky for you, but this is almost the same thing as a iron condor, except you're dealing with more kind of a calendar situation or a diagonal situation. So, you know, and you could bring these in So instead of 600, let's just bring these in a little tighter, 710. And here we'll go about 690. So you can see now we're getting in a little bit closer here on that spread, but the situation now is this one is now positive Vega, but it's kind of like an iron condor. All right, Carla here. Good morning. Is standard deviation important for picking up contracts? I don't understand the concept. Standard deviation just tells you the range of movement. Well, it depends on what you're looking at. Here, take anything. Okay, here is a line. Okay, here is the end of that line, and here's the end of that line. Okay, so we've got price that moves on the pink line. Okay, now, how far are we if I put a, let's say, a green dot over here and over here? Well, we're not that far away. Small standard deviation. If we go further out, let's go orange, even further, okay, further standard deviation. That means your probabilities, right? And if you go all the way to the edge, now you're looking at that 98.6 kind of standard deviation, or 99.4. So you're getting all the way into these ranges of your bell curve on these standard deviations. So really the Bollinger Bands will tell you the standard deviations. So if you look at anything like a Facebook, are we near the top range or the bottom range, or are we more at the middle? If you look at other stocks, you can see some are kind of near the top range. So that means chances are you'll probably get a pullback. So if you're looking to set up option trades, yeah, you could use this as a tool, but it's still a tool, and you still have to manage the positions. So ultimately, you still gotta manage it. There's more to it than just, this. I'm just trying to simplify because we're getting close to running out of time. And if you're looking at standard deviation, it really just depends on the movement, the range of movement, because we know that when stocks stretch really, really, really far, they'll probably come back down. I mean, they're not rocket ships. This isn't NASA. This isn't a spaceship. They do pull back. Even Tesla, when it was having its amazing run, which, a rare run, but amazing run right here, it's still pulled back quite a bit. Take a look at that next bar after a bit. They do pull back, and it takes time for it to stabilize. You look at some, Ulta Beauty, when it's got this big downward move, you still got this counter trend that'll come back. So, all right, so here's one more time. So Sasha, in ISO, we look into set up a calendar as long as the IV of the security is low, expecting to go up and capitalize. And Iron Condor, we expect the volatility to crash as we are. All right, a lot of people, they look at, hey, put on an Iron Condor when the VIX is high. Put on a, I get what you're saying, Juan. Should we not set up the calendar? No, it's not that you can't set up the calendar when the VIX is low. It's not that you can't set up the calendar when the VIX is high. It's not that you can't set up the Iron Condor when the VIX is low or high. You can do it in any condition. It's just you would do it differently. And that's kind of beyond the scope of this video, but you would do them differently. Why would you do them differently? Well, because you have to plan for a volatility crash or spike. So one final point here, let's go into, let's see which one, Harley Davidson. I don't really look at it too much, so it's a good one to look at. If the volatility is, let's say, extremely high, the highest ever, could I still set up a calendar on this? Yes, but how would I do it? Well, I would do it differently. There's two approaches to it. Number one, because I know I'm going to get hurt on the Vega. Okay, since we're talking about calendars, I'm focusing the attention on calendars. Since I know I'm going to get hurt on the Vega, I got to make this calendar bullish, much more bullish, right? Or I could convert it into a diagonal. So I could do something like this, where it's a more bullish calendar, because I know I'm going to get hurt on the volatility. So that means the VIX was really, really, really high, because I know I'm going to get a volatility come down, which means I'm going to get hurt. So that's one thing. So VIX comes down, let's say it goes down 3 points, boom. But that also means price has moved up probably around here. So that's one way. Okay. The second way is to compress. okay, compress your time. Why would that be important? Well, if you compress your time, your theta to your vega ratio becomes much more. Look at this. How many times, if your theta goes to work at your plant, in your business, if this goes to work, how many times, if you got vega that doesn't show up to work, you lose $33 on your supplies? Okay, if theta goes to work, you only make $4 on your supplies. So how many days does theta have to go to work to make up 1 day of vega? So if you got 2 employees, some work really hard, some don't. This is what I'm talking about. So it takes about 9 days, right? 9 times 4, 36. Okay, 8 times 4, 32. 8 days. So if you got a 1 day problem here, it takes 8 times to make it up. That's an 8x ratio, right? 8 times. Now, if I compress this and I go to a shorter duration, let's say I go to March and I go to February, take a look. Watch. Look at just what happened. Look at what just happened. Okay. Now, the calendar is smaller. That's the trade-off in terms of width for your price. But my theta to my vega, now this is the biggest. So really, if I got a 1 point volatility problem, it's not a big deal because my theta is way bigger. Let's go again. Let's go, instead of March, let's go to this March, and instead of this February, let's go to, let's say, this one. Okay, now how many days? What's my ratio in this case? Well, this is about a 2x ratio, 2, maybe 3, 2.5. So it only takes about 2 days to make up a 1x volatility problem. So you compress the duration, you trade off, and you get your theta to work harder, but there's always trade-offs for the delta. Anyways, that's the long and the short of it. It's not that you can't do calendars on a high VIX or low VIX. It's not you can't do iron condors, high VIX, low VIX. It's you would do them a little bit differently, okay? So that's the way it would really work out. Anyway, I hope this makes sense. Gives you some thoughts. Let's see, what is this account doing, or these accounts? Down about $5. These S&P trades down about 38 points, and we are down about $40, $50. Still, the trades look fine, so no big deal. Bank of America, you can see we're down about $30 since we put this on. I'm not too worried about it. It's a small position, so you know, you could see right here what happened right away. The volatility. This is what goes on. This is what happens when you've got volatility that works against you. Now that white line drops. Boom. Makes sense? All right. I hope to see you guys in the options membership plan. If we don't get enough members, we're just not gonna do the live sessions or do them. You know, because that helps fuel and pay for the team and all the other things that we do. So please support us, support them. And also get yourself education and learn, so that way you're not losing on trades and you don't understand why. You know, try it out for a month, see what happens, and you could learn quite a bit. So thank you so much for joining me, and I hope to see you in the membership plan. All right, last question, are you bearish about the market in general? It's not that I'm bearish, I look at the market as, are we stretched? And in this case, yeah, we're stretched. So that's the way I look at things. It's not that I'm bullish or bearish. It's just, hey, are we stretched? If we're stretched, put less cash on, put less trades on. If you're not stretched, if you had a sell-off, it's a good time to buy or not. In this case, hey, we're stretched. So be a little more cautious. All right, signing out. Thank you, and enjoy the weekend ahead. I'll see you next time.